Welcome back to the channel. Today I'm going to be talking about the prospect of selling Boohoo and why this wouldn't be such a bad idea, and ultimately what I have been learning and adapting my strategy to overcome. I'm going to be talking a lot about averaging down in the markets, whether it is actually a sound strategy or is it what it seems. And if you feel this video delivers more value than the usual ones, please share one of these, as it does help any new viewer find a good quality video on the channel, as some of them have been pretty poor in the past. Now, I've been looking at my holdings quite a lot lately. Again, yeah, it's the same old thing where you keep refreshing them every 5 minutes and seeing how much they've updated. But I've been thinking, okay, I've not done very well. My overall portfolio is down about 50% since I started investing in these individual stocks nearly 3 years ago now, right? That's not a very good performance. It doesn't quite put me up there with the likes of Warren Buffett, Peter Lynch, and others. However, I've been going, okay, I've done quite badly. What have I done wrong in this time? I've identified quite a few core mistakes. Namely, the one being the fear of missing out, lack of understanding in some of the investments I bought. Again, Argo blockchain comes into that one. And I think another one could actually be here. Obviously, poor risk management and averaging down without proper due diligence. Now, at the time, I've always assumed that I've averaged down with good common sense, with a sound and fundamental basis in which I believe the investment is still of a good quality. And what's really prompted this idea is actually seeing a tweet by a person on Twitter called Michael. Now, I have absolutely nothing against Michael. I followed him for about a year, maybe a bit more, and he usually had quite a high exposure in his portfolio to the likes of Boohoo. You can see here that he's actually now decided to sell out of Boohoo, despite making a lot of money from 2015 to 2020. He actually lost a lot going from June 2020 until today's date. And there are quite a few good questions here, like the idea of would you buy now? And it started to get me thinking, do I believe I should sell Boohoo right now? No, I don't think so. I think they're a good quality company. I think the management are doing the right decisions. But again, you've got to be thinking about this idea. And ultimately, I feel that I need to be doing more research to gather more understanding to make an appropriate decision in this matter. And I'm thinking about here, when you've got capital on the side of the markets, let's say you've got $1,000 in cash, you're like, okay, do I invest it in the stocks I currently hold or not? And you've got one stock that's performing quite well and one that isn't, just on share prices alone, right? Do you then water the weeds, start averaging down on a stock that's down 50% because it's got a lot more upside potential, or do you continue to water the flowers where you've got the good quality business that's generated a good profit so far, but it might be a little bit overpriced? Where's the balance there? What do you ultimately go for? And that's why the idea of selling Boohoo here is quite a key symbol. Perhaps in hindsight, I could have done things a lot differently, and obviously in hindsight it's very easy to say that. So it's like when we look at my portfolio here, I've got an overall loss with Boohoo of about 18 grand. Now that is a huge amount, and perhaps I haven't fully come to the concept of reality. Right now, my Boohoo shares are worth 1/3 of what they were worth when I first bought them. This is not a good thing, and if I decided to somewhat sell these shares, I'm not going to realise any of that original invested value back, and I'm actually sitting on a far lower amount. Now, I've always said that Boohoo will recover over the longer term. I believe in the company, I believe in the fundamentals, right? That was my mindset. And that's going, okay, look, in 5-10 years' time, the share price will be higher than what my average was, as long as I can keep growing, and therefore I will be in a good place. It's just temporary damage. And obviously that's going to test your mentality. I feel I'm quite strong at this because I've got a good stomach for loss, namely because I don't need access to this money for a very long time. And again, it's all in the spirit of learning, mainly for me. But it still provokes that point. Am I in denial about the stock being down this much, or will it truly recover? So perhaps I need to identify if Boohoo right now, right, was a new investment for me, and I had to look at this stock as if I would like to buy now, would I be buying shares of it? And before I go on to that, there's another tweet here by an analyst called Paul Hill. He does a lot of videos with Vox Markets, for instance, and it doesn't quite show what he's done, but basically he's got a position in Boohoo, but what he has said is that he's not been averaging down on this, although his reasons are different in this comment because I couldn't find the original one, which was probably over 2 years ago now, where he had mentioned it. He's gotten quite a high average. I think it's a little bit higher than mine from memory. Again, nothing against that. But what he has done is he has shown good discipline in risk management. He's prevented himself from getting overexposed to position and namely kept a good exposure to a multitude of companies. And this plays out. It's like I've always seen a stock go down and I thought, okay, you know, if they're a good business, I'm going to average down, right? And when you're looking at index funds where they're diversified across 500 different companies or even more across the world, you see that index fund drop in value and you see the earnings overall in, let's say, the global economy is increasing, then you might go, okay, it's a good idea to be buying more now. I'm going to average down on this investment because it's very likely over a 30-year period, this is going to be much higher. For an individual stock, that's a little bit more difficult because, again, a business can struggle. A business can no longer be as profitable as it once was, and there were many challenges that a business must overcome. And that's why when I'm looking at the likes of Paul Hill here, as shown on the screen, where he has not been continuing to average down, and he has, I suppose, had quite a resilient performance in that regard, versus my portfolio where I'm down 59% year to date. So it's like going, is it only worth averaging down when the fundamentals are consistent or improving? And otherwise saying, you know what, look, my shares are falling, but also the fundamentals are falling. Is the fundamentals deteriorating at a rate where I should sell? Well, with Argo blockchain, they were. They were taking up ridiculous levels of debt in the portfolio, in my portfolio anyway. And they were going, look, we're going to expand. We're going to buy more Bitcoin miners. We've built this whole massive Helios facility. Don't worry, we've secured this debt. We've secured this debt. We're going to dilute shareholders. And now look at them. They're on the verge of going bust. Their shares are now worth, I think, less than a few pence compared to where they were at £3 each. It's not a good sight for the company, especially when they were taking on short-term loans waged on the price of Bitcoin, and Bitcoin went down. It would have looked amazing in the future if Bitcoin went up in that time, but it didn't. So therefore, they played a very risky play, and I realized they were doing that and decided to sell out because I felt that the fundamentals were deteriorating rapidly, and I didn't see a future for the company. With the likes of Boohoo, however, the fundamentals aren't deteriorating rapidly, but I would be lying if I said they aren't deteriorating. After all, this was a company that had loads of cash and absolutely no debt, to now a position where they've got cash and debt at an equivalent level. Now, that's not necessarily a bad position. A lot of companies can do this. A lot of companies have done so in the past. But again, it adds to that level of risk compared to where they once were. When you go towards Games Workshop, in stark contrast, they now have absolutely zero debt. They have plenty of cash on the balance sheet, and they've priced in enough cash in the balance sheet to say we have now got 6 months worth of emergency expenses due to the pandemic. They've now adapted and they can survive very tough climates. Again, but Boohoo's fundamentals have been deteriorating. And even though recently I've bought an additional 1,000 shares at around about a £400 purchase, it has really got me thinking, would I actually buy this stock if I had to buy this investment right now? And I mean, you look at the graphs, you look at the past performance, right? The trend for the company doesn't look so great. The earnings are decreasing. Again, you would have to do further research into why this is happening. I mean, the free cash flow shows the same trend. This could be a concern. But then you look at the industry and you go, okay, ASOS, the likes of others, have also seen a similar trend. Perhaps it's cyclical. Perhaps this is a struggle that is not exclusively shared by Boohoo. You look at their financial health, you go, okay, look, they've increased their debt a lot. This is not a good trend. This is not something I'd like to buy into. And they do hold a lot of cash, but it might not be good enough. They're unlikely to go bankrupt with that level of cash on the balance sheet. But again, we're likely to see that cash go down as they're continuing to be unprofitable. And we're likely to see this investment in terms of asset value decrease over time until they reach profitability again. Which at the moment, where we're looking towards heading into a recession, profitability could be on the minds of everyone and could be a very difficult feat to achieve. Although Boohoo is a volumes-based business and they sell low-cost products to consumers and they can likely navigate the idea of a recession very well, it does still put a concern on the investor's mind and therefore a struggle. So for me, when I've got an average in Boohoo of £1.20 a share, should I be averaging down? Should I be buying more, really lowering the average? As I say, I bought £400 worth of shares and I was able to chop my average down from £1.24 to £1.20. If I keep doing that, I can get a very respectable average price. But I've been doing this for such a while that my initial average price when I first started buying Boohoo was about £2.70. If I'd have left my position like that, my Boohoo shares would probably be 10 times as less, but then I would have lost 10 times as less money. Who knows where else I would have put that money, whether it would have been a wise investment, or whether I would have still lost money elsewhere. But it's certainly food for thought in your investment strategy. Aimlessly averaging down not necessarily is a good idea. However, I do believe Boohoo, as I've said, will go up over the longer term. It's a tough decision. Should I really be buying now or not? And I think really it's an effective gamble on the future at this point in time. I believe in the business. I believe in their prospects. I think the management are very capable and they're doing the moves that I would be doing in their position. But without greater understanding of the industry and knowing what's really going to happen here in consumer spending, you're kind of at the mercy of the economy at the moment, and that is maybe not favourable. Perhaps there isn't enough of a significant advantage here for it to go up. And who's to say once they're profitable again that they're not going to reach that same, obviously, price to earnings multiple, but also profit margin. Things could be tougher in the future. But again, these are all fears. These are all things keeping the price down now. What's not to say in 5-10 years' time, Boohoo actually reaches peak profitability, they have higher margins than ever, and they're doing very well. Again, that's what uncertainty brings, and uncertainty obviously discounts values in the stock market, and that's why it could be a good opportunity to buy. But I disagree with the likes of Michael here. I think he's made a sound choice. I think he has sold his investment. But I think after that point, I think really he should have sold it either an earlier point, again in hindsight, no hate against Michael, or alternatively continue to hold. And rather than trying to cut that loss, if you don't believe the business is going to grow in the future, actually I think he's got a fundamentally sound logic there. I'm going to backtrack on myself because I'm pretty sure his tweet did say that. However, if you do believe it's still going to grow, perhaps the approach that Paul Hill has taken, where you've got the position and you will only average down if the fundamentals are consistent and or improving. If not, it's worth just leaving and continuing to hold. Sure, you're not going to get the highest return in the world, but ultimately, at least you're going to have exposure to that stock, and you're not going to lead yourself into let's say, a struggle that I've reached where my portfolio is down 53%. Thank you for watching today. I hope you enjoyed it. Have a fantastic day.